Hello guys, welcome to today's topic on low resistance liquidity runs in consolidating price action conditions. So essentially what we're going to do today is we're going to discuss how to essentially engage consolidated market environment, which is a different protocol from engaging in the market environment that has a very clear order flow. Now what we're going to do is we're going to have to break down what a consolidation is, build upon the concept, and then define how to approach trading type consolidations using what I call the quarter theory. So we're going to discuss the quarter theory, we're also going to discuss consolidation, and we're going to discuss low resistance liquidity runs in consolidation. So hopefully you enjoyed this, and I will get down into this lesson. Now the first thing we have to do is we have to define what a consolidation is. So I call consolidation a stable flow of liquidity. So when there is no huge order in price, the market usually will go into what I call a tight squeeze, and the market will squeeze in price and squeeze in price. And what this does is this builds sentiment in the marketplace, because the different market participants they have expectations on price. Whenever a price goes into squeezes like this, everyone has expectations of what they think price should be doing. Now once price starts to expand, then obviously you get market expansion in price. This consolidation is what we call a liquidity base. Now we call this a liquidity base because a lot of times in consolidations like this, there will be a large order from a terminal, okay, that will trigger the algo to get into best bid, best offer, essentially expansion in price. And that huge order could be, let's say, 300,000 contracts. All right, so we have 300,000 contracts coming in one terminal of a bank, and that triggers the interbank algo to go into to go into a self-protective mechanism, and which is where you get the classic expansion. And what the algo does is the algo continues to beat higher, so any new client coming into a different bank terminal, okay, they cannot bid at a lower price than where this huge order came into the marketplace. All right, now this video is not to get into details of how price delivers and what causes price to deliver, but it essentially just breaking down in a basic way what consolidation is and why you get expansion out of a consolidation. All right, so you usually have a trigger in price, and that trigger starts the delivery cycle, and the delivery cycle is seeking for the next objective liquidity. Why is it going to seek for the next objective liquidity? Because at the next available liquidity is where transactions can be offered with volatility. Alright, so there's going to be a lot of interest at that liquidity. It could be a short-term high, long-term high, a bearish fair value gap, but something at premium would be the objective that the algo will be expanding up into to facilitate new transactions, either to square positions, to engineer new positions. We don't know what that is, but all we're seeing is usually in what we call a liquidity base, aka consolidation, stable flows liquidity will come in at a certain time, and then the algo will start the expansion cycle. So just to rehash what a consolidation is, a consolidation essentially is a liquidity base where there's no clear order flow. The market is neither trading higher nor trading lower. Now that does not mean because the market is in the sideways price delivery, that does not mean we're not going to see expansion. There are still ways you can go about trading consolidating the market conditions. Now what consolidating market conditions is notorious for is engineering liquidity in a small little range and running both sides of the liquidity. Now the first step to approaching trading consolidations is to have an objective draw of where you think the higher time frame delivery cycle should be. Alright, so it's the higher time frame. So when I say higher time frame, I essentially mean the daily time frame, like we discussed on the previous videos. Now you can refine your higher time frame understanding of price to a daily time frame perspective. So once you have your daily buys defined, where's the next obvious draw on liquidity on the daily time frame? Because usually the daily time frame could still consolidate, but a lot of times the quick expansions will be seen in direction of the daily order flow. Now in consolidated market conditions, you don't want to go with a general approach to trading trending market conditions. So trending market conditions are market conditions with a very clear delivery cycle. So they are showing clearly one-sidedness. Consolidated market conditions don't show one-sidedness. They show sideways price action. So the market just goes sideways. You do not want to go into consolidated market conditions looking for your classic return down into a discount. If you're bullish on your daily time frame, looking for continuation longs, it does not work as efficiently as in a very clearly trending market condition. Now, the reason why is because price has a lot of propensity to move back into equilibrium, which is the hallmark of consolidation. So usually what happens during consolidations is there is what we call a mean price, okay? And that mean price is the mean threshold of the range, which we'll call the equilibrium of price. And what price a lot of times will do is price will whip back and forth between that mean price, running stops on both sides of the range, okay? And price whips back and forth. And what a lot of traders do, which I used to do in the past, and sometimes I still fall prey to, is they will go into the marketplace looking for continuation, and they'll look at this as a return back into discount, for example, looking for a continuation higher, and the market just runs right through, and then the market starts to trade higher again, and then they look at this break higher and say, okay, since daily order flow is bullish and we're seeing a retracement down here, these are equalized, right? So let me go in and look for a bounce, return back into discount, looking for a continuation higher, and then the market slams lower again. And as soon as the market slams lower, it quickly moves back into consolidation and does the same thing. And if you do not know how to navigate a market condition like this, you could lose a ton of equity. You could get beat up in the marketplace, and you can lose your composure easily. Now, you have two options. You can either avoid trading a market condition like this, or you trade the way I'm about to explain to you right now, which is one of the most efficient way of trading price action consolidation. Now, what we're using here is we're using the theory of how price moves in consolidation, whereby price will move around the mean price, which is the equilibrium of the trading range, and that's the classic characteristic of a consolidation. Willingness and price to return back into equilibrium of the range. Okay, now what you want to do here is you don't want to go in looking for a classic return or continuation patterns. Alright, so I'm just going to sum it up into continuation patterns. So continuation patterns is looking for a continuation long at discount rate that is not a rejection block or an old low, or looking for a continuation short at a premium array that is not a short-term high or a bearish rejection block. That's not how you want to approach price action trading. You want to approach price action trading in consolidated market conditions by utilizing the turtle soup. Now let's discuss what a turtle soup is. This is not my idea. This is not my concept. I cannot remember. There was a book I read one time. It was recommended to me by ICT, and the book was talking about, there were a group of traders. I think it was around 1973 or 1960s. It was around the 1960s or something, and they had a model. Should I call it a model? They had a model, and it was called the turtle trading model. And what they usually did was they faded the run above a 20-day high. Okay, so this is not like your short-term trading. All right, so they found out that usually when price broke above a 20-day high, so 20-day meaning the last 20 days of price action on the daily time frame, usually when price broke above that high or broke below the low, that usually was not a true running price, right? That usually was a false running price, and the market usually would then reverse from there. And so they created a model off of that, and they called it the turtle soup model or turtle trading model. And essentially, it's just a false run above a short-term high. Okay, and again, what we're doing here is we're not waiting for a 20-day high. All we need to do is we can apply this on lower time frame with a very clear understanding of a low resistance liquidity run in direction of daily bias. Again, now this is the essential part. We need to identify a very clear low resistance liquidity run in the direction of our daily order flow. And we need to do this using our quarter theory, which I will explain shortly. All right, so a Terra essentially is fading the breakout of a range. Okay, so if you're anticipating bearishness and you see a sudden, and that's the hallmark of the Terra price makes a sudden run and expansion out of a range, and when price makes that sudden run and expansion out of the range, traders will chase along. Remember, the attention is not on price prior to displacement. When there is expansion, that's when all the eyes is on that asset. All right, so everyone's all buzzing about, oh, look at this asset just expanding higher. And that's the time where you're gonna go in, because a lot of traders are going to chase this long, expecting a consolidation higher. And usually, what this run does is to engineer liquidity on the sell side. Okay, and then you see a lot of times the market will whip back down lower, and it does this very quickly. So whip back higher very quickly, and the speed of delivery usually induces longs in retail, and then the market will consolidate a little bit above the eye, give a lot more people a chance to want to trade the breakout pattern, and then whip back lower for the sell side, and usually it will do that very aggressively. Okay, so this is a Terra sell, and then a Terra buy would be the market running aggressively below a short-term low, and then seeing a little bit of a retracement and aggressively running back to clear out the buy subs that was induced at the run of the short-term low here by all the sellers chasing the run lower. And that's how you get your classic Terra scenario. So whenever you hear me talk about Terra buy, you understand that's a breakout, a false breakout of a short-term low with a reversal, and the Terra sell is a false breakout of a short-term high with a reversal. Now let's talk about the quarter theory. Now, price usually, I think I discussed this in the last lesson, price usually will deliver from the point of origin to terminus. Okay, so the two key components to our quarter theory is our origin and our terminus. Alright, so origin is where price starts the delivery cycle, and terminus is where price ends that delivery cycle. So we have terminus here, or let's use caps, that makes it better. So we have terminus here, and we have origin down here. Now what the market would do is the market would deliver from origin to terminus a lot of times. Now the market usually delivers two ways. The market will either deliver in market maker models, remember the commercial legend program. We're going to talk about market maker models on the day trading course, but price will deliver in two ways. It will either deliver in market maker models or using the quarter theory. Now the quarter theory usually is very important for consolidating market conditions. They're very, very, very effective, and I'll show you shortly. They're very effective for trading consolidations, and I'll show you how to utilize them. Now the market would make a move in 4 quarters. The market will go higher. Let me actually use the Falcon tool, and then returns back into base, and this is the what we'll call initial expansion, or just a word for it. I'm trying to remember the word for this. The move that actually starts the initial expansion higher. Let me actually go through my journal and see. So it's skipping right now, and I'm trying to find out the word for it. Yeah, so it's called the impulse price swing. Okay, that's the impulse price swing, and that's what we'll call the first swing grade. Alright, so we have the first swing grade in price, and usually the origin will originate from an high time frame level. So let me just put this in caps. Alright, so we have the origin, and it's going to be higher time frame discount. And if you hear the noise in the background, I am currently hopping around houses because I'm working on stuff, so I do apologize for that, but I want to get work done during this weekend with you guys, so I just have to do what I can to get some content created. Alright, so we have our first swing grade, and we have our, this is usually what we call the impulse price swing, or the impulse leg in price. And then we have the second swing grade, which usually I talked about this in the previous lesson. it's kind of like an A B C D extension, or what we call a measured move. All right, so usually when you're trading a continuation from the impulse, you can look for your 200 Fibonacci extension level, which essentially is one standard deviation of the impulse leg. All right, so you have your second swing grade there, and then you have a return back there to equilibrium, and then you have your third swing grade, and price runs for terminals. All right, now equilibrium of the range obviously is here. Now the key thing about equilibrium, especially for consolidation, is a lot of time the market will bounce back and forth around equilibrium. And this is why I told you guys that if you're going to trade equilibrium, you have to understand that you're going to have to be a little bit more patient. You cannot just go into price at equilibrium and rush looking for an entry, especially if the market has shown consolidation leading up into the run into that into the equilibrium of the trading range. All right, so you have to exercise patience in terms of approaching price action, looking for executions, because what the market tends to often do is the market will tend to often build in more sentiment around equilibrium and then use that to engineer the run higher. Now the thing is, the run from the initial origin, or the origin, not the initial origin, the run from the origin usually is very fast and defined, which is what we call institution sponsorship from the high time frame level, and the run to terminus is also very fast, right? Because this is the closest to liquidity, and the market usually has to quickly run for where there's available liquidity to allow for pairing of orders from all the accumulations from down here. Now, in between the second grade of price swing and the third grade of price swing, you will tend to see a lot of runs on consolidations. Now, how do you use the quarter theory for price action? Once you identify the origin of an existing range and the terminals of the existing range, what you could do here, and I want you to pay very close attention to this, and this might be something you might have to watch a couple times to fully grasp or get, and I will encourage you to actually watch this a couple of times to fully understand what I'm saying on this recording or this lesson. Define your origin, which usually will be an high time frame level. Define your terminals, and you have your equilibrium of the range, obviously. And what you want to do is you want to divide your terminals and equilibrium. So let's label this actually. So I'm going to label this EQ, which stands for equilibrium. And between your equilibrium and your terminus, you have 2 quarters. Okay, you have your fourth quarter, which is the last quarter leading up into terminus, and then you have your third quarter, which is the second to the last quarter leading up to terminus. And then between the origin and equilibrium, you divide the range into half, and you get your first quarter and the second quarter. So this is a quarter theory. Again, you identify the terminus of an existing range, because usually the market will consolidate inside an existing range. So what is the terminus of that existing range? What's the origin of that existing range? Define that range, divide it in half, and then divide the half into half, and then you get your 4 quarters. You have quarter 1, quarter 2, quarter 3, quarter 4. So we're going to label this is quarter 1. I'm going to label this Q1, right? And this is going to be quarter 2, Q2, quarter 3, this is Q3, quarter 4, this is Q4. So we have Q1, Q2, Q3, and then Q4. All right, so the market, we're anticipating market to deliver in 4 cycles. Now, in each of this quarter, we have equilibrium and discount. So we're going to do this. And I know it's starting to get a little bit complex, but I promise you it will make sense. So divide the range of the first quarter into equilibrium versus discount. So what I'm going to do here is I'll make equilibrium red. Let's use red. All right, that actually works for this. So red indicates sell. All right. And we're going to do the same for quarter 2, identify equilibrium. So I'm just doing this to speed up the process. Sorry, I messed this up. So quarter, come on. Quarter 1 is this. Quarter 2 is this. Okay, awesome. Quarter 3 is this. So all we're doing is we're identifying premium in each quarter. That's premium up there. Quarter 4 here. That's premium right there at quarter 4. Okay, so we've identified the premium of each range. And then obviously the remaining half of each quarter is discount. So we're gonna do for discount here. We're gonna make them green. Alright, so green for discount, which is buy. Okay. And what I want you to do is I want you to actually go and backtest this to check for the validity of this. Alright, so go and backtest this and you see how often it plays out. I know you've not seen me do this in a live session. It's a lot of work doing this, but I don't do this every time, but there are times where I employ this, but I don't just show them in the live session because that's going to get a ton of questions like, well, what is this? And it's a lot to go and break down and explain what this is. Okay, so I'm trying to make this perfect, and I think I have OCD. I've talked about this before. It'll eat at me if I don't make all the lines align. Alright, so we have each quarter, and with each quarter we've defined premium versus discount. Alright, so for quarter 1 we have premium and discount. Premium is red and discount is green. I don't know if you can call this red or pink, but it is red. Quarter 2 is red for premium, green for discount, just like your buy or sell. Alright, so buy is green, or bullish candles are green, and bearish candles are red. Alright, so for quarter 3, you have your green for discount and red for premium, and then quarter 4, you've got your green for discount and red for premium. Now, once you've defined your daily order flow, and daily order flow could be bullish. So in this example, we're going to look for bullishness. Alright, and what we're seeing is, even though we know the market is more poised to sustain a consolidation, but we're still expecting the market to trade into terminals higher. All right, and we've defined our range, which is high to low. Now we're expecting delivery, and we're anticipating consolidation, or we've seen evidences of consolidation. So what you do here, remember, when you are trading in consolidations, you don't want to go in and just look for straight up longs. Okay, you want to look for a terrace of longs at the discount of each quarter at a specific time. So what I just told you now, this is a model itself. This is a short-term trading model in itself for trading consolidation. So what I want you to do is I want you to look at the ranges this year, use this quarter theory, identify your range, identify the quarter theory, and look for the time to align with a terrace of long, and that will make so much sense. And it will blow your mind actually. Alright, so again, what are the sessions you're looking for buys or sells? Yeah, you're looking at this during New York session, and I don't want to get into each individual session because we're going to cover that on the day trading course. But you're doing this, let's start from let's do it in order. Okay, so you have your London session first, and then you have your New York session, which you're looking at, which you are hunting these setups. Okay, you have your London session, New York session, and then you have your London close. So we're going to get into the timing of these sessions, okay? But we don't want it to detract from what we're discussing, the concept we're discussing in this video. All right, we're going to get into the timing of these sessions. But essentially what you're looking for is you're looking for a terrace of long around these sessions during the day, inside of each discount of each quarter. So here's how you do this. So now let's say we see the market expanding higher. I'm going to use this. And then trades down here like this. Do you go in and look for a buy? You don't. Why? Just no run on short-term stops. So you then go in and look for a buy. Then the market expands higher. And it starts to trade like this. Do you go in and look for a buy? No. Why? Because that is at the premium of the first quarter. You don't buy at the premium of the first quarter. But now, if the market went like this, is that a buy? Yes. Why? Because we've run below a short-term low. We're inside the discount of first quarter. This is our origin, and our bias is looking for bullishness. Now, I'm not saying this is a strategy or a price action approach that will not net you losses. You're going to get netted losses, but it's going to be very, very few, from my experience. Okay, so if you actually know what you're doing, you follow the timing, right, and you understand your daily order flow, this is very beautiful for trading consolidations. Now, what you expect here is displacement. Displacement for what? Short term, the recent liquidity run, which you've identified here, where you have your bias liquidity. And then maybe some kind of premium rate to the left of an old price action of the range that we utilize in defining terminus and origin. Now the market gets up into premium of quarter two. Do you go in here looking for buys? No. Why? It is at the premium of quarter two. Don't go in there looking for buys at premium of quarter two. Now the market trades lower here, back into the short-term range. Do you go and look for buys there? You don't. Why? That is not a Taurus sub long. Again, we're not just going in looking for continuation patterns to trade long. We're looking for Taurus sub longs if our daily bias is bullish at a specific time of day. Alright, inside the discount of each quarter. Now, if we see the market expand higher like this and then slam down like this, and again, all of this has to align with either London, New York, London close. That's when we're looking for these opportunities. Is that a buy right there? Of course it is a buy, because that is at the discount of quarter two. And then you look for a buy right there. You're aiming for the buy side liquidity resting up here. The market goes up there. Now, where are we trading at relative to the range? The equilibrium of a trend range. What have I told you about equilibrium of a trend range? The market can oftentimes whip into a very tight consolidation, mini consolidation inside an overall consolidation to build in sentiment in the marketplace. So what do? You wait. What are you waiting for? You're waiting for an aggressive run against your intended direction. So I want you to listen to me again. At equilibrium of the range like this, you're looking for an aggressive run against your intended direction, and that's the tip off that you are seeing manipulation on the way for expansion into your anticipated liquidity. So what the market would do is the market will do something like this and go back and forth. And do you buy down here? No, you don't. You're not buying down here. Why? Because that is the premium of quarter two. Then the market runs higher like this and then trades lower like this again. Now, do you buy down here? Yeah, because that's at the discount of quarter two, not the premium of quarter two. And we have layered liquidity like this. So we can go in here looking for longs. Again, that's also aligned with time of day. And then we aim for the lower liquidity run up here. The market does stuff like that. Alright. Now, usually, remember, in the last leg or the last quarter, price will be very one-sided and fast because we're nearing the available liquidity in the marketplace. So usually from quarter one to quarter three, you can get that kind of Taurus of longs like that. But when you're trading at quarter three, after seeing significant expansion from equilibrium, a lot of times the market will aggressively want to expand for terminus. Now, sometimes it might trade down into quarter four, and it might not have a defined run of stops like this. It might be a smaller run of stop like this. And then it runs high for quarter four. So this is expected at quarter four, not the kind of very sudden run lower and then reversal higher. At quarter four, the discount, not the premium. The run of stops are usually not that quick, and a lot of pips, if I show you that way. So it's not as much of in terms of pips as from quarter one to quarter two to quarter three. But again, what you're looking for, the characteristic is time of day and discount of the quarter. If your daily bias is bullish, obviously if your daily bias is bearish, then you're not looking for buys, you're looking for sells, and that's aligned with time of day and time of week. That's what you're looking for. Now let's go and view this in theory, or not in theory, in practice. And so recently we had a consolidation with cable, between 13th of April on Friday, and we saw the market break out of the range. Not even 14th of Friday, sorry. 14th of April on Friday. Actually, on 10th of April on Monday to 14th of April, that's where consolidation starts, or that's where the range that creates this consolidation starts. So you're gonna define a range with that. Okay, so the discount low of our range is here, and the prime high of our range is up here. All right, so we've defined our range. All right, so the high of the range is here. That's the high of the daily candle at 14th of April, and the low is at the 10th of April. Now, if we broke this down to a lower time frame, what we're going to do here is we're going to divide our range into half. So we have this as our origin, which starts our range, higher time frame range. We have this as the terminus, where we're anticipating price to trade up into. Now remember, what has price been doing prior to this consolidation? Price has been bullish, and we're expecting the market to run for the biceps that are up here. So obviously we're anticipating bullishness in price. Okay, and we're seeing displacement from a mitigation block and a breaker block. Alright, so not this mitigation block, but this breaker block instead, because this were the last two candles that run lower, clear that sell stop, so that's a range. Alright, so on the lower time frame, we've already defined that we're bullish on the daily, so we're obviously going in looking for buys, not sells. That's what we're looking for. Let's see, the internet is a little bit slow today. Let's see if it actually restarts. If it does not, I'm going to connect to my phone, and we should be good. By the way, I'm using Starlink, so sometimes it can get like this. Alright, so we're back. So we're going to define the range from the low to the high and look for the equilibrium of the trend range. And this is going to be equilibrium here. And what I'm going to do is I'm going to break this down lower. And we're then going to define each quarter of our range. Oh, okay. So I want to define the quarter of each range. Let's use the horizontal ray here. And let's go for something better. We use purple for each quarter and do the same thing. Oh. Okay. And here. So what we have here is we have first quarter, second quarter, third quarter, and the fourth quarter of our range. This is what starts the range low. This is what starts the range high. So we're gonna divide the line here, and that's what starts a range. Okay, so everything after this is what we're concerned with. Alright, so what we do now is we divide each quarter into its own premium versus discount, and we have this here, and we're just going to divide this into the discount of the range. So we're only concerned with the discount of the range. We're not interested in premium, so just no need for us to outline the premium of the range. So that's the discount of quarter one, and then of quarter two, the discount is down here. And then for quarter three, we have our discount down here. And then for quarter four, we have our discount down here. Alright, so the unshaded lines or zones are the premium of the range, and the shaded zones are obviously the discount of the range. So now what you can see here is As we return back down, once the range is formed, as we return back down into discount, which is an old higher time frame level, we have a run on sell stops down into discount. Is this a good buy? It's not, because it's outside of kill zone. Our kill zone is London, New York, or London close. So that's not a good buy right there. But again, we're still bullish. Now this is on Wednesday, and what you can see on Wednesday is during a London session at discount of quarter two. This is London session. We have a clear high here. We have the market run a short-term low here and here. That's a buy. Runs up for short-term buy stop into a premium, and then that's done. Do you buy the retracement down back down into this? No. Why? It's not a Terra long, so we're not buying. Number two, it is at premium of quarter two. So let's define each quarter so it makes sense. Alright, so this is quarter one, which we're going to call Q1. This is quarter two, which we're going to call Q2. This is quarter three, which we're going to call Q3. And obviously we have the quarter four, which we're going to call Q4. And this is terminals of our range. Alright, so let's make this a little bit larger. So that's price terminals of our range, essentially where our target objective is. And this is for quarter three, for quarter four, for quarter two, and then for quarter one. Alright, so you can see here that this is not a good buy because that's at the premium of quarter two and it's not a Terra long. But here during New York session, that's a buy, aiming for the biceps up here, because that's a run below short-term low inside of the discount of quarter two at the time window, which is a session. I told you to look for longs, so that's a buy. So you have two buying opportunities right here. Now on Thursday, you have a short-term low here. This is right around London session. Is this a good buy right there? No, because at the premium of quarter two, we're looking for price to trade into discount of quarter two for a buy. Right here during New York session, that's a good buy right there. Now you would obviously be aiming for the clean eyes up here because that's equalized to you. So if you bought this, let's assume you did not get take profits. Alright, that's fine. Then what happens the next day? Price just slams lower down into where? Premium of quarter one. Do you buy this run lower? No. Why? Because that's at the premium of quarter one. But this is at London session. Now going to New York session, we have a run again below short-term low. Right during New York. Down, actually not New York, this is London close. So the exactly sort of London close, we have a run down into discount of quarter one. Do you buy right there? Yes, you do. Now do you see the difference here? The buys are not good. The Terra buys are not good are the ones occurring at the premium of each quarter. Like here, you could see, oh, this is a Terra long, but it's not a good Terra long because that's occurring at the premium of quarter one. But the real Terra long occurred at the discount of quarter two. Now the market expands away from there, and then during London session on Friday, it trades down into the discount of quarter two. Do you buy that? No. Why? Because there was no run on a short-term low. So this would have been something you missed out on. Okay, all of this would have been something you did not get to participate in, you missed out on, and that's fine. The market eventually runs for the cleaners up here. Alright, heading into the new week. This is Monday of the new week. Heading into Tuesday of the new week. Do you buy here at the discount of quarter three? No. Why? Because it's not running on a short-term low. Okay, it's just trading lower. Just no run below short-term low, so that's a good buy. Remember, where did we trade up into? This is equilibrium. Remember this black line here between the terminus and the origin? That's equilibrium. What did I tell you about equilibrium? You would see usually the market go into very sudden runs against your buys. That's what the market does at equilibrium. A lot of times it can go into protracted consolidation. Look at all the consolidation around equilibrium. Why do you think price is going back and forth? What's the mean price? Price is going back and forth around this dashed line here, because that's the mean price of our terminus and origin back here. That's why price is going back and forth. So as soon as we break out of that equilibrium, there's no assurance that we see a lower time frame, short-term chart, so long looking for continuation. The market runs aggressively back down into the discount of quarter two. At what time? London close. Is that a good buy right there? Yes, because it's a discount of quarter two, running out the nearest short-term low we had, which is down here, into a discount, which is this bullshit block. Now there are other confluence like key time from levels, but I'm not gonna draw that here because that's not the goal of this presentation. Okay, and that's a buy right there, aiming for the lower resistance that could run up there, and then the market expands for that, and then creates a short-term low, and then trades higher, and then trades down into discount of quarter three. Okay, again, remember this is where we're expecting price to trade up into. Price trades down into discount of quarter three during when? London launch. Do you take this as a buy? No. Why? It is outside our kill zone. Right? We don't trade London launch. It is outside our kill zone. And then price expands higher and then runs lower again below our short-term low. But look at the bodies of the candle. The bodies of the candle never leaves the discount of quarter three. So you might say, well, it traded down into a premium of quarter two. But look at the bodies of the candle. Again, the bodies of the candle tells the story. This is not trade down into or through the premium of, the discount of quarter three. So you have another source of long here, aiming for the buys up here, or the biceps up here, and also here. Remember, when we start to expand from equilibrium and we head into quarter four, we see the market start to displace in the quarter four. A lot of times they're going to be very fast because that's the, we're nearing liquidity, and that's what you see here. As we got into quarter four, look at the range of the candle because the market wants to quickly get up into liquidity. Alright, so hopefully this was an insightful video, and what I would advise you to do is to go and do your own back testing to validate the concepts being discussed in this lesson, and I'll see you on the next one. Trade safe.